Please like, share, and subscribe. Wishing you happiness and good luck every day.
Warren Buffett. You know the name. One of the wealthiest investors in all of history. So how'd he do it? You're probably picturing this library of super complex financial models and top secret algorithms. But the truth? The real foundation of his entire philosophy, the very core of his fortune, it all comes from the principles in just 3 books. And today, we're going to unpack the simple but oh so powerful ideas from these books that built a multi-billion-dollar empire.
I mean, just let that sink in for a second. More than 50 years of success, again and again, all guided by the wisdom in a few books. Some of them were written before your grandparents were even born. This is not about chasing the latest trend or just getting lucky. Nope, this is about a timeless framework that turned knowledge into absolutely staggering wealth.
Right. That's the billion-dollar question, isn't it? Because let's be honest, these books can be incredibly dense, really tough to get through. But the core concepts, they're surprisingly simple, almost intuitive. And that's our job today. We're going to slice through all that jargon and lay out the fundamental secrets that anyone, and I mean anyone, can understand.
So here's our game plan. We'll start by really getting what stocks and bonds are. Then we'll dive into the wild psychological roller coaster of the market itself. And finally, this is the best part. We're going to connect all the dots and see how these pieces fit together to create one seriously powerful strategy.
Okay, first things first, stocks. To really wrap our heads around this, we're going to forget all about Wall Street for a minute. Instead, let's head over to a neighborhood golf course, where the first secret of investing is being run from a simple little card table.
So, meet Billy. He's this young, sharp entrepreneur, and he has a booming business selling lemonade and golf balls to all the thirsty golfers. You know, he's disciplined, he works hard, and he makes a steady profit, day in and day out. He's built a genuinely fantastic business.
And then the offer comes in. His buddy Joe, he's just mesmerized by all the cash Billy's raking in, and he wants a piece of the action. So he offers $300 for the whole operation. Now, you got to put yourself in Billy's shoes. He's made $300 over the entire summer. This offer sounds like a lottery win. He's about to double his money in an instant.
But before he snatches that cash, he asks the single most important question in the entire world of investing. He doesn't ask, how much can I get for it? No, he asks, what is this business actually worth? And that, right there, is the crucial difference. Understanding that the price someone throws at you is not the same thing as its true value.
So Billy, being a smart kid, goes to his dad, George. And George lays out a fundamental lesson. A business doesn't just have one value. It actually has 3. You've got the price someone offers you, you've got the value of all its stuff right now, and then, the most important one, the value of what it can earn over its lifetime.
Okay, so first up is what we call book value. Think of this as the garage sale value. If Billy just shut everything down today, sold his table, his pitcher, all the lemonade mix, everything, he'd walk away with about $85. It's just the value of the physical stuff. That's it.
Next, you have the market price. This one's easy. It's simply what somebody is willing to pay you for something right now. In our story, it's Joe's offer of $300. But this number, it's all about emotion and perception and what other people are doing. It can be completely disconnected from reality.
And here, my friends, is the secret sauce, intrinsic value. This is the real deal, the genuine worth of the business, calculated based on all the money it's expected to make in the future. So when Billy's dad helps him do the math, they realize the lemonade stand, it's actually worth $2,100. Whoa! Suddenly Joe's $300 offer doesn't look so hot, does it?
So Billy gets clever, real clever. He knows his business is worth way more than what Joe offered. So instead of selling the whole thing, he divides his business into 1,000 tiny little pieces, we call those shares, and he offers to sell them for just $1 each. And poof, just like that, by setting the price for a small piece, he sets a brand new, much higher market price for his whole company, $1,000.
And this is a brilliant lesson in how markets really work. Because a $1 share feels so cheap and exciting, all the neighborhood kids want in on it. They're not doing any math, they're just caught up in the hype of Billy's awesome business. Even Joe, the guy who wouldn't pay more than $300 for the whole company, is now happily buying shares at a valuation of $1,000. They all forgot to ask that one simple, powerful question.
So that's how we figure out what a business is worth. But owning a piece of a business, a stock, well, that's only half the story. To really get Buffett's strategy, we need to understand the other major player in this game,
bonds. Billy's business is just humming along, but he sees a way to make it even better. There's this fancy new lemon squeezing machine that costs $1,000. The problem? He's $100 short. This is a classic problem for any business. How do you pay for growth when you don't have all the cash sitting there?
His solution is to issue a bond. Now, don't let the word bond scare you. It's really just a formal IOU. He borrows the $100 he needs. That's called the face value. He promises to pay it all back on a specific date a year from now. That's the maturity date. And for the privilege of using that money, he'll pay 5% interest. That's the coupon rate. At its heart, it's just a loan.
And that's all it is. Seriously, never forget this simple equation. When you buy a bond, you're not buying a piece of the business. You are becoming the bank. You are the lender, and you get paid back with interest for your trouble. It's a totally different relationship than owning a stock.
Okay, so we have stocks, which are pieces of a business, and we have bonds, which are loans. But where do these things get bought and sold? They exist in the market. And the market is an environment that's driven way less by spreadsheets and way more by two very powerful human emotions. I want you to imagine the market is a giant lake, just teeming with fish. Now, someone tosses a tiny pebble of bad news into the water. Does just one little fish get scared? Nope. The entire school of fish scatters instantly in a total panic. That's fear. It's irrational, and it spreads like wildfire. But the opposite is just as true. What if someone starts throwing handfuls of free food into one tiny corner of the lake? What happens? Every single fish swarms that one spot, desperate to get a piece of the action. They get so focused on that feeding frenzy that they completely ignore all the other perfectly good food in the rest of the lake. And that, my friends, is greed. So you have these two extremes constantly at play. Greed, where everyone blindly jumps on whatever's popular, pushing prices up to insane levels, and fear, where everyone panics at the same time and sells everything, pushing prices down to ridiculous lows. The smart investor knows that both of these reactions are actually just opportunities in disguise. And this all leads us to what is maybe Buffett's most powerful and well-known piece of wisdom. Don't be one of the fish. Don't just follow the school. Your job is to do the exact opposite. When everyone in the market is euphoric and greedy, you should be cautious and fearful. And when everyone is panicking and fearful, that is your moment to be greedy.
And this is where it all comes together. We've talked about stocks, we've talked about bonds, and we've talked about market emotions. Now let's see how a truly smart investor, like Billy's dad George, uses all of these concepts to build real, lasting wealth.
Okay, let's walk through the logic here step by step. 1. A big recession hits. The market is terrified. The fish are scattering everywhere. 2. What do scared people do? They run away from risky things like stocks and they pile into what they think is safe, which is bonds. This huge demand drives bond prices way, way up. This is your moment. You sell your bonds, making a huge profit from the fearful crowd. 3. At the exact same time, that same terrified crowd is panic selling their stocks, making even great profitable companies incredibly cheap. 4. The final move. You take all those profits you just made from selling your overpriced bonds and you use that cash to buy those wonderful businesses at a massive discount. You are zigging while the rest of the world is zagging.
So, the crucial point of all this is this. The real game isn't about trying to pick the next hot stock. It's about understanding value and human emotion. It's about asking yourself, no matter what the market is doing, where is the crowd going? And more importantly, where is the real intrinsic value that they are completely ignoring right now? Answering that question, that's the key to everything.
So, what if I told you that everything, and I mean everything, you need to know about the stock market, from valuing a company to dividends, could be explained by a 12-year-old's lemonade stand? Sounds kind of nuts, right? But stick with me here. By the end of this, you're going to see how a simple neighborhood business can make the entire world of Wall Street make perfect sense. All right, let's get into it.
Yeah, I know, a lemonade stand? But seriously, the drama, the deals, the profits, it all holds the keys to understanding how the world of investing really works. And our teacher for today? Well, he's a 12-year-old entrepreneur. Okay, so let's meet our main character. His name is Billy, he's 12 years old, and he runs this crazy successful lemonade stand right by the 5th hole of the local golf course. I mean, this kid is a machine. He's disciplined, he's making a profit, he even sells lost golf balls on the side. He is a little business owner through and through.
And his best friend Joe has definitely been watching. So one afternoon, Joe just comes tearing up on his bike, shouting this at the top of his lungs right in front of all Billy's customers. Billy is, totally mortified and tells him to get lost. The stand is not for sale. But Joe came prepared. He makes an offer that just about makes Billy's jaw hit the pavement. $300. You got to put yourself in the shoes of a 12-year-old here. This is a kid who's ecstatic to make $10 on a good day. $300 is like life-changing money. It's everything he's made all summer, and his mind is just racing. He's thinking, wait a minute, I can get paid for the rest of the summer right now? But before he jumps on it, he knows he's got to figure something out. What is his business actually worth? So here's the key part. How does Billy first try to answer that question? Well, he does what a lot of people do. He just adds up the value of all his physical stuff. The card table, the goofy Mickey Mouse picture, the lemonade mix. It all comes out to a grand total of $85. So he looks at Joe's $300 offer and he's thinking, this guy is a total idiot. I'm about to be rich. But is that really all the business is worth? That night, the deal with Joe falls through, and Billy's dad, George, steps in. He can see his son is about to make a massive mistake because he's only focused on the price of his equipment. So he decides it's time for a lesson on the difference between price and true value. George explains that $85 Billy calculated, that has a name. It's called book value. It's basically what the business is worth if you just shut it down and sold all the parts today. But the intrinsic value, well, that's something else entirely. That's the real value, because it includes all the money the business is going to make in the future. And this is where the light bulb really goes on. George asks Billy, hey, how long are you planning to run this stand? Billy says, until I'm 16, so I can buy a car. So George does the math. Based on what he's earning now, Billy could make another $300 this summer and then $600 a year for the next 3 years. All of a sudden, this business isn't worth $85. It's worth $2,100. That is its intrinsic value. So with all the numbers laid out right there in front of him, the answer is just obvious. No way, Billy says. He finally gets it. Joe wasn't offering him a fortune. He was trying to buy a money printing machine for pennies on the dollar. And that, right there, is maybe the single most important lesson in all of investing. You have to understand what the business is truly worth before you even think about looking at the price. Okay, so Billy decides not to sell. But guess what? Now he's got a whole new problem. Turns out Joe has been telling everyone in the neighborhood how much money the stand makes, and now every single kid wants a piece of the action. Billy's totally overwhelmed, so he goes back to his dad for more advice. And George, he comes up with this brilliant plan. He tells Billy, okay, forget the $300 offer, and for a minute, even forget the $2,100 intrinsic value. What's the price you'd be willing to sell for right now? Billy thinks about it and says, $1,000. Perfect, says his dad. That's your market price. The plan is just beautiful in its simplicity. Divide the business into 1,000 tiny pieces, call them shares, and sell each one for $1. So the next day, Billy's out there standing on a crate with a box full of these little hand-drawn certificates. And he makes his big pitch. For just $1 single, his friends can own a piece of his super successful business. And because the price is so low, the other kids, they don't even think about the $1,000 valuation. They're just thrilled to be a part of it. And it works. It's a huge success. The shares sell out almost immediately. By the end of the day, Billy has sold 100 shares and pocketed a quick $100. But here's the genius part. He still owns the other 900 shares. He's still got 90% of his company, meaning he's in complete control, and he just sold 10% of it at a valuation more than 3 times what Joe originally offered. Pretty slick. All right, let's fast forward 45 days. Summer's winding down, and it is time for the company's first ever earnings call. All the new shareholders gather in Billy's living room, and they're buzzing with excitement. They're owners now, and they are ready to get paid. This is it. This is the only thing on their minds. They put their hard-earned money in, and now they want to see a return. Joe, who sunk a whopping $45 into 45 shares, is practically bouncing off the walls. This is the moment of truth for Billy's little corporation. Billy stands up and announces that the stand made $300 in profit since they all bought in. Then he explains how the dividends are going to work. Each owner gets a piece of that profit that's proportional to how many shares they own. Now, since Billy still owns 900 of the 1,000 shares, he gets 90% of the profits, a cool $270. His friends, the minority shareholders, have to split the remaining $30 among all of them.
And Joe is furious. All he can see is that he put in $45 and he's only getting $13.50 back right now. He's not thinking about the fact that he just made a 30% return in 45 days. He's not thinking about his shares being good for future summers. Nope. He's just comparing his tiny pile of cash to Billy's huge pile, and it feels completely unfair. This, my friends, is investor emotion in its purest form. Joe demands his money back, and just like that, a wave of panic washes over the room. All the other kids start getting nervous. Billy, thinking fast, makes a new offer. He'll buy back everyone's shares for 70 cents on the dollar. The kids, who just want to cut their losses, they all jump at the deal. They get their initial investment back once they combine the dividend and the sale, and they cash out. And just like that, Billy is the sole owner of all 1,000 shares again, and he just pocketed $30 of his investors' money in the process. Okay, that was a whole lot of neighborhood drama, I know. But this little story is a perfect, bite-sized model for the entire stock market. So now, let's take everything we just learned and translate it into the language of Wall Street. These are the key metrics every single investor needs to know. First up is earnings per share, or EPS. This is a super simple but really powerful number that tells you how much profit a company makes for each individual share. For Billy's stand, it earns $600 in a full year, and there are 1,000 shares. You do the math? $600 divided by 1,000 is 60 cents, so the EPS is 60 cents. It's just a great way to standardize how profitable a company is. Okay, next up, the price-to-earnings ratio, or PE ratio. To get this number, you just take the stock price and divide it by that EPS we just talked about. So when the kids bought their shares for $1, the PE ratio was 1.66. What this tells you is how much investors are willing to pay for every single dollar of a company's earnings. Now, Billy's PE is incredibly low, but in the real stock market, you might see PE ratios of 15 or 25 or even way higher for big companies, depending on their industry and how fast people think they're going to grow. And this right here is the secret to really understanding what a PE ratio means. Just plug the number into this one simple sentence. For Billy's stand, it would be, for every $1.66 I spend buying this company, I can expect $1 in earnings a year later. The lower that PE number is, the cheaper the stock is compared to its earnings, and the better that sentence sounds. And finally, let's talk about dividend yield. This is basically the return you get just from the dividends relative to the share price. Now, since Billy pays out all of his earnings, the annual dividend is 60 cents per share. At a $1 price, that's a completely insane 60% yield. I mean, for perspective, a lot of really solid dividend stocks in the real world might have yields of like 2 to 5%. And get this, when Billy offered to buy back the shares at 70 cents, the yield for a new buyer at that price would have jumped to over 85%. It just goes to show you that a lower stock price can actually mean a higher yield. So this all brings us to the final and most important question. Joe, he got caught up in the excitement, the fear, the raw dollar amounts. He wasn't thinking like an owner. Billy, on the other hand, he understood the long-term intrinsic value of what he had actually built. He knew what his business was worth. So the question I want to leave you with is, which one are you?
Welcome to The Explainer. You know, some financial topics can seem, well, super complicated. Take bonds, for example. But what if I told you we could break it all down with a simple story? A story about a boy, his dad, and a lemonade stand. Let's get into it.
Okay, so picture this. Young Billy comes tearing home from his first day of school, just totally fired up. He runs up to his dad, George, and he's like, "Dad, my friend Joe just got a savings bond, and he said he's going to make all kinds of money with that thing." And of course, Billy, not wanting to miss out, immediately wants in. And that leads him to ask the big question.
So, what exactly is a bond? I mean, it's a question that sounds intimidating, right? It's wrapped up in all this Wall Street jargon. But the truth is, the answer at its core is, well, it's surprisingly simple.
This is where Billy's dad, George, just cuts right through all that noise. He gives Billy the first and most important lesson you'll ever learn about bonds. He tells him, a bond, it's just a simple loan. Yeah, that's it. That's the big secret. When you buy a bond, you're not buying a piece of a company like you do with a stock. Nope. You're actually acting like the bank. You are the lender. You're giving your money to someone, a person, a business, even the government, with a promise that they'll pay you back, plus a little extra for your trouble. And to make this idea really stick, George uses an analogy that's perfect for Billy. He brings up Billy's lemonade stand, and he says, hey, remember that amazing lemonade we had at the carnival? The secret was that fancy lemon squeezing machine they had. Then he asked Billy a question. If you had a machine like that, do you think you could sell way more lemonade? And of course, Billy's eyes light up. Yeah! But, like with any great business idea, there's a problem.
The goal is simple. Get that machine, sell more lemonade, and grow the business. The machine is what you'd call an investment. It's something that's going to help Billy's Snack Shack make a lot more money down the road. But here's the catch, right? Investments, they cost money.
And this machine, it's got a pretty hefty price tag. We're talking $1,000. Now, for a kid running a lemonade stand, that might as well be $1 million. That's a lot of cash. And this is where we hit the classic problem, right? Billy's been a great saver. He's got $900 ready to go. He is so close, but he's still $100 short. He can't buy the machine yet. So what's he going to do? How does he get that last $100? So George puts it right to Billy. How are you going to get that extra $100? And Billy, thinking logically, says, well, I guess I just have to wait and save up the rest. And look, that's a perfectly fine answer, but think about it. Every day he waits is a day he's not selling extra lemonade with his new machine. That's lost profit. But then George introduces a second option, a game changer. He says, or you could issue a bond. What does that mean? It means getting that $100 in cash today. He could buy the machine right now and start making more money tomorrow. It's all about borrowing money to get a head start on growing his business. Okay, so this whole thing isn't just some casual, I'll pay you back later kind of deal. It's a formal agreement. It's got paperwork. So George decides to break down the anatomy of this bond for Billy, piece by piece. First, you've got something called the face value. You might also hear it called par value. Don't let the fancy name fool you. It's just the amount of the loan. Simple. For Billy, the face value is that $100 he needs. It's the original amount he promises to pay back when the whole deal is done. All right, next up is the coupon rate. Now, this is the interesting part for the lender. This is the interest. It's basically the fee that Billy, the borrower, agrees to pay for the privilege of using someone else's money. You can think of it like paying rent on cash. In this story, they agree on a 5% coupon rate for the year. And to make it all official, George actually draws up the Billy's Snack Shack bond. Look at this thing. You can see all the pieces we just talked about right there. The issuer, Billy. The face value, $100. The coupon rate, 5%. It's even got the start date and the end date, what they call the maturity date, 1 year later. And check out those little detachable coupons at the bottom. Each one is like a little IOU for a future interest payment. Now, to really make sure this all sinks in for Billy, George doesn't just talk about it. He actually demonstrates the entire life of the bond, step by step, using real cash. This is where it gets good. So here's how it plays out over the year. On September 1st, George, acting as the lender, buys the bond. He hands Billy a $100 bill. Fast forward 6 months. Billy gives George $2.50. That's the first interest payment. Then another 6 months go by, and it's September 1st again. It's maturity day. Billy pays George another $2.50 for the second interest coupon, and he gives him back the original $100 loan. So let's just do the math here for George, the guy who bought the bond. At the end of the year, what does he have? Well, he gets his $100 back, so he's whole. But on top of that, he's got $5 in his pocket from those interest payments. He made a 5% return on his money in 1 year just for lending it out. Pretty cool, right? The whole system worked perfectly. So after seeing the cash actually move back and forth, from the initial loan to the final payback, George looks at Billy and asks, so do you get it now? And you can just see the light bulb go on over Billy's head. He gets this huge grin on his face and yells, I sure do. It's not just some weird financial idea anymore. It's real. Billy's lemonade stand story is honestly a perfect way to understand this stuff, and it all boils down to one single, super important idea. If you remember one thing from this whole explainer, let it be this. I mean it. Never forget this. Purchasing a bond is the same as providing a loan. It doesn't matter if you're buying a bond from the US government or a giant company like Apple or even your local town to build a new school. At the end of the day, all you're doing is providing a loan. And that little mental shift, it changes everything. Because when you buy a bond, you are the lender. So you have to start thinking like a bank. You have to ask the tough questions. Is this person or company actually going to pay me back? What's the risk here? Is the interest they're offering me enough to make this risk worthwhile? See? It completely changes how you look at the investment. Now, a quick little note on the lingo, just so you know. In the real world, these loans have different names depending on how long they last. If it's a year or less, it's called a bill. If it's between 1 and 10 years, it's a note. And for the really long ones, we're talking 20 years or more, that's what they call a bond. So yeah, technically, Billy's lemonade stand loan was a bill, but honestly, the underlying idea is the exact same for all of them. And all of this leaves us with one last really big question, doesn't it? I mean, Billy's bond was pretty simple, but in the real world, when you've got thousands of companies and governments all wanting to borrow money, how do you decide which loan is a good one to make and which one is just too risky? Now, that's a whole other can of worms, but it is absolutely the right question to start asking.
All right, today we are going to dive into the psychology of the market. And believe it or not, it all starts with a really simple story that takes place at a lake. A story that, I promise you, holds the key to understanding how billions are made and, well, how they're lost. This right here, this is the whole thing in a nutshell. It's a quote from a boy named Billy, and it's basically the foundation for everything we're about to unpack. It is an absolute masterclass in contrarian thinking, and it all begins by seeing what literally everyone else is missing. Okay, so here's our game plan. We're going to start with that story about Billy and the fish. Then, we'll connect the dots to how the market really works. We'll look at how billionaires use this exact logic, dig into the critical difference between price and value, and then we'll do a super simple calculation with a lemonade stand that makes it all click. And finally, we'll talk about your ultimate edge in this whole game. Let's do it.
So our story starts with this kid, Billy, and he is not happy. He's been dragged on a summer vacation to Pymatuning Lake, when he'd much rather be at home running his successful lemonade stand. But little does he know, this trip is about to teach him a lesson about business that's way more valuable than anything he could have learned on the golf course.
So picture this. Billy and his new friend Gary are just hanging out on the dock, skipping rocks. Now Billy's a city kid, so when he sees this giant school of fish swim by, he's totally mesmerized. It's a completely new sight for him, and he's just fascinated.
So Gary, being a typical kid, decides to, stir things up. He grabs a small rock and just tosses it right into the middle of the school. And the reaction is instantaneous. In a blink, every single fish panics and scatters in a million different directions. Billy just stands there, completely captivated by this wave of collective fear.
And this is where Billy asks the million-dollar question. How did they all know? I mean, think about it. The rock was a tiny little pebble. The actual danger was maybe for 1 or 2 fish right where it landed. So why did the entire school bolt like that? This, right here, is the mystery of herd behavior.
Okay, so fast forward a few days. Billy's dad takes him to a pier to show him something a little different. And what he sees is the exact opposite of what he saw before. Instead of scattering in fear, there are thousands of fish just swarming, going crazy, fighting each other for tiny scraps of food that people are tossing into the water.
And Billy's dad breaks it down for him. He explains the instinct behind this feeding frenzy. It's just pure greed. He tells Billy, look, one fish sees his friend getting free food, and after a few of them get a bite, every single fish in a lake gets greedy and rushes in. It's the complete flip side of the fear we just saw.
And this is the moment it all clicks for Billy. He's looking at these thousands of fish fighting over crumbs in one tiny little spot. And then he looks out at the huge, empty lake, and he has this brilliant insight. The smart fish, the one who wants an easy meal, he wouldn't be here in this chaos. He'd be out in the middle of a lake where all the real food is, completely ignored.
Okay, so let's take that simple story and connect it to the world of investing. Because, as it turns out, Billy had just stumbled upon the single most important lesson in the entire market. You see, investors and fish, well, they have a lot more in common than you'd think.
Instinct, fear, and greed. These 3 words perfectly capture why those fish behaved the way they did. And guess what? They are the exact same forces that drive the behavior of almost every single investor out there. They are the reason why that old saying, buy low and sell high, is so incredibly hard for people to actually do.
The parallel here is it's uncanny, right? The fish scatter from one tiny rock, completely ignoring the fact that the threat is minimal. Investors panic sell everything because of one piece of bad news, following the herd instead of looking at the facts. The fish swarm for what they think is free food, and investors chase after hot stocks they hear about, hoping for easy money. The key here is that both of them are just focused on what everyone else is doing, not on the underlying reality.
So if most investors act just like that school of fish, constantly bouncing between fear and greed, how do the most successful investors on the entire planet behave? Well, it's pretty simple, actually. They've learned to do the exact opposite. They have trained themselves to think just like Billy did at the lake.
And this quote from Warren Buffett just says it all, doesn't it? It's not just some clever line. This is the literal operational playbook for building incredible wealth. It means you go shopping when everyone else is panic selling, and you get cautious, maybe even sell, when everyone else is blindly piling in, thinking it can't go down.
Let's break down how this actually works. During a time of widespread fear, like a recession, the public thinks stocks are the riskiest thing you can own. But wealthy investors, they see this as the least risky and most profitable time to buy. Why? Because great companies are on sale. Now flip it. During a cycle of greed, a bull market, when the public is all in, savvy investors see that as the most risky time because prices are being pushed up by nothing more than emotion.
So, how are they able to do this? How can they stay calm when everyone else is freaking out? Well, it all comes down to understanding the crucial difference between two very important ideas, price and value. And trust me, they are not the same thing. So first, let's define market price. This is really simple. It's just the opinion of the crowd. It's the number you see flickering on the screen. And it jumps all over the place based on news, emotions, fear, and greed. It's the emotional value of something at one specific point in time. Intrinsic value, on the other hand, is a totally different animal. It has nothing to do with feelings. It's the real, underlying, calculable worth of a business based on its ability to actually make money. This is a number you figure out through analysis and math, not by looking at a stock ticker. And this is what the smart investors are focused on.
All right, theory is great, but let's make this concept crystal clear. We're going to use a super simple example that takes us right back to Billy's lemonade stand. This is where you can really see the massive difference between price and value in action.
So, imagine a kid named Joe has $45 to invest. He's got two choices. Option 1, a super safe savings bond that earns him 3%. Easy enough. His $45 becomes $46.35. Option 2 is to invest in Billy's really profitable lemonade business. If the price is fair, say just $1 a share, his $45 gets him 45 shares. Now, each one of those shares earns 60 cents a year. So after 1 year, his investment is worth $72. At this price, it's a no-brainer. Billy's company is the way to go.
But what happens when the herd gets greedy? What if the hype around Billy's stand gets out of control and the price skyrockets to a crazy $20 a share? Remember, the business itself, the lemonade, hasn't changed at all. Well, let's walk through it. First, the new price is $20. That means Joe's $45 now only buys him 2.25 shares. The earnings are still 60 cents per share, so his total earnings for the year are just $1.35, which means his $45 investment is now worth only $46.35. That is the exact same return as the totally risk-free bond. The high price completely wiped out the value of owning a great business. So here's the absolute critical point of all this. The business was the same. The lemonade was the same. The earnings were the same. The only thing that changed was the price, which was driven up by pure greed. Your job as an investor is to learn to completely ignore the noise of those price swings and focus only on the real, calculable value of the business underneath.
And this, right here, is the final and most empowering takeaway from this whole story. Your greatest advantage in investing isn't some secret formula or a hot tip from a buddy. It is the discipline to do your own homework, to calculate the value, and to trust your own judgment. Even when, and especially when, the rest of the herd is sprinting in the opposite direction.
So I'll leave you with this one question to think about. The next time the market starts to panic, or gets totally euphoric, and you feel that little tug of instinct, or fear, or greed, are you going to swim with the school, focused only on the other fish around you? Or are you going to be the one who looks up, sees the rock for what it really is, and calmly swims toward the quiet part of the lake, where the real opportunities are just waiting?
All right, let's get into this. I want you to picture this scene. It's the start of Billy's senior year of high school. You know what that's like, right? Life is all about chasing girls, shining up your car. The last thing on your mind is like finance. But that's all about to change. And it all starts with one car ride with his dad.
So Billy's outside working on his car when his dad, George, comes out, briefcase in hand. He looks like he's on a mission. He asks Billy if he wants to tag along to the bank. But before Billy can even really answer, George's tone just shifts. It's not a question anymore. That look on his face says it all. This isn't just a trip to the bank. This is the start of a lesson that's going to stick with him for the rest of his life.
So they get in the car, and the lesson begins right away. But George doesn't start with some boring lecture about saving your money or making a budget. Nope. He goes for something way bigger. He asks a simple question, one that's designed to just shatter Billy's little high school bubble and drag him into the real world. And Billy, being a teenager and completely oblivious, he just cracks a joke. The Steelers are playing really well. I mean, it's a classic response, right? But it creates this amazing contrast, because what George is about to drop on him has absolutely nothing to do with football, and everything to do with the economic storm that's raging all around them. George's face gets grim, and he just lays it out, plain and simple. The country is in the middle of a massive recession. And this trip to the bank, yeah, it's not for a routine deposit. George is on his way to make a huge financial move, one that goes completely against what everyone else is doing.
And this right here is the heart of the lesson. You've got the whole country on one side, just panicking, selling off their stocks like their hair is on fire. And then you've got George on the other side, calmly doing the exact opposite. He's selling his safe investments, his bonds, so he can go buy up those very same stocks while they're on a massive discount. Billy gets it instantly. This is a total contrarian move.
This really gets to the core of how George thinks. See, he's not ignoring the fear in the market, he's using it. For him, all that widespread panic isn't a signal to run for the hills. It's a giant flashing green light. It's telling him that now is the time to act, to zig when everybody else is zagging. So what is George actually selling? He calls them his conservative fixed income securities, but you and I know them as bonds. The easiest way to think about a bond is like a loan. You're loaning money to a company or the government, and in return, they promise to pay you back with interest. Now, when times get scary economically, people love bonds because they feel safe and predictable. Okay, so how is George making a profit on these things right now? It all comes down to this simple comparison. The bonds that he bought a few years ago, they pay a sweet 6% interest. But because of the recession, any new bonds getting issued today are only paying about 3.5%. I mean, it's a no-brainer, right? Which one would you rather have? The one paying almost double?
And let's look at how this turns into actual cash. George originally paid $1,000 for each of his bonds. But today, since that 6% interest rate is so much better than the new 3.5% ones, he can sell his for a whopping $1,432. That's what he calls an enormous premium. And that profit? Well, that's the war chest he's about to take and deploy into the stock market.
And then George gets really serious. He explains to Billy that what they're witnessing is a fundamental cycle of the economy. In these moments of crisis, a huge transfer of wealth happens. The people who get it, who understand the cycle and act with courage, they thrive. But the people who react with fear, they often get wiped out. The message to Billy is crystal clear. His entire financial future could depend on which side of that line he ends up on. But look, George's brilliant move today, this wasn't just some lucky spur-of-the-moment thing. Not at all. This was the final move in a game of chess he started playing years ago. To really understand how we got here, we have to rewind the clock, back to a time when the economy looked totally different. The whole strategy is beautiful when you see it laid out. 3 years ago, things were booming. The crowd was greedy, just piling into the stock market. But George, he was quietly buying up those boring 6% bonds. Now, fast forward to today's recession, and the whole thing has flipped. The crowd is terrified, selling their stocks at a huge loss, while George is confidently cashing in his bonds to scoop up those exact same stocks for pennies on the dollar. George tells him, look, I could have easily just followed the herd 3 years ago. It would have been the easy thing to do. But he had the discipline, the foresight, to see that the stocks everyone was so hyped about were actually way overvalued. So he chose the less exciting, but ultimately much, much smarter path. And as George is laying all of this out, you can almost see the light bulb just flick on over Billy's head. He's starting to see the pattern, right? The core principle that connects everything his dad has been doing for the past 3 years. He's about to boil this whole incredible lesson down into one single, powerful idea. And this is it, the golden rule. You've probably heard it before from Warren Buffett, but here's Billy figuring it out in his dad's car. It's so simple, but it's so powerful. You do the exact opposite of what the emotional crowd is doing. You get greedy and buy when everyone else is panicking. And you get fearful, or at least very, very cautious, when everyone else is euphoric and greedy. Billy is a smart kid, though. He gets the principle, but he immediately asks the million-dollar question. Okay, that sounds great, but how do you know? How can you actually tell when other people are being greedy or fearful? How do you take this from a cool-sounding quote and turn it into a real practical strategy you can actually use? That's the question that separates the amateurs from the pros. And George loves this question. He explains that his method isn't about gut feelings or trying to read the news. It's actually super simple and logical. It's just a comparison. You figure out the potential return you can get from stocks, and you figure out the potential return from bonds. Then you just put your money in whichever one is offering the better deal at that time. That's it. Of course, Billy's next question is the obvious one. Okay, Dad, but how do you actually figure that stuff out? He's a little skeptical. And you can see him realizing that while the idea is simple, the execution, that takes real work and real knowledge. There's no magic formula you can just plug in. And that's George's final piece of wisdom. There are no shortcuts. No one can just hand you financial freedom. It's something you have to earn. It comes from taking personal responsibility, starting with the absolute basics, and making a commitment to teach yourself. It's a call to action, not just for Billy, but for all of us. As they finally pull up to the bank, the lesson from the car ride comes to this incredibly powerful conclusion. This was never really about stocks and bonds. It was about something so much deeper, the power to control your own financial destiny. And this is the ultimate takeaway. Real success isn't about getting lucky or trying to predict the future. It's about being prepared. It's about knowing that these cycles of greed and fear are going to happen again and again. Your fate isn't determined by the conditions of the market. It's determined by how you are prepared to react to them when they show up. And that leaves us with one final, very challenging question. George's entire philosophy is built on one core belief. The majority, driven by emotion, is usually wrong at the most important moments. To succeed like he does, you need more than just knowledge. You need the courage to stand completely alone, to be buying when everyone you know is panic selling. So the question for you is, are you prepared to do that?
All right, let's jump right in. Before you ever put a single dollar into an investment, there is one huge, fundamental question you've got to answer for yourself. And that's what we're tackling today. How do you, personally, define success?
You know, this quote really just hits the nail on the head. For so many people, the market isn't a place for careful planning. It's a casino. They're making moves based on panic, on hype, on what everyone else is doing. It's just a chaotic, emotional mess, and honestly, it's usually a recipe for disaster.
And that really brings us to these two totally different mindsets. Over on one side, you've got the gambler. They're reactive, they're chasing hot tips, they're letting fear and greed grab the steering wheel. But on the other side, you have the investor. And that's who we want to be, right? Calm, logical, someone who makes moves based on research, not raw emotion. Having that clear head is probably your single biggest advantage out there.
Now here's a really powerful way to picture this. The stock market isn't some magical machine that just prints money out of thin air. It's much more like a giant poker table. Think about it. The house isn't creating new chips. It's just a place where chips get pushed from one player's stack to another. Wealth is simply being transferred.
So, this leads to the big, tough question. If you're going to sit down at that table without a strategy, without really understanding the odds, you have to look yourself in the mirror and ask this. It's that moment of gut check honesty you need before you put any of your hard-earned money on the line.
So here's our game plan for this explainer. First, we're going to stick with that poker table analogy for a bit. Then we'll get right to the core of it, defining success for yourself. After that, I'll introduce you to a really powerful tool called the risk-free standard. We'll see how it works with a real-life story, and finally, we'll figure out how you can decide what your price is for taking on risk.
Okay, Section 1, the market's poker table. Look, before you can have any shot at winning, you have to know the game you're playing. The big idea here is that you've got to understand the room, the odds, and who you're playing against before you even think about making your first move.
But here's the good news. You don't have to be that person who loses their shirt.
By taking a disciplined, responsible approach, you can do way more than just get by. You can actually come out way ahead. A good system can seriously boost your returns, but maybe even more importantly, it's your armor. It protects you from making those big, catastrophic mistakes, and it shields you during those market crashes that, let's be honest, history tells us are going to come around every 6 to 10 years or so.
So how do we actually build that discipline? Well, that leads us straight into Section 2, defining your success. This is everything. It's the bedrock. Every single decision you make from here on out has to be measured against the standard that you set ahead of time. So it all boils down to this one question. What is the absolute bare minimum return an investment has to give you for it to even be worth your time and money? Seriously, if you don't have an answer for this, you're just flying blind.
So how do we find an answer? That brings us to Section 3, the risk-free standard. I want you to think of this as your secret weapon. It's like a golden ruler that you can pull out and use to measure every single opportunity that comes across your desk.
And what is this golden ruler? It's the 10-year federal treasury note. All this is, really, is a loan you're making to the U.S. government. And it's seen as the gold standard of risk-free investing for one very simple, kind of mind-blowing reason. If the government ever gets in a jam and can't pay you back, they can literally just print more money. They can't default.
Now, to make this real, when this source material was written, the annual yield on this note was 2.125%. That number right there, that's our baseline. That's the return you can get without taking on basically any risk of losing your original cash.
So what does that number actually mean in the real world? It's super simple. If you bought a $100 note, Uncle Sam would pay you about $2.13 every year for 10 years straight. Then, at the end of the decade, you get your $100 back. It's simple, it's predictable, and it's safe.
And this brings us to the big aha moment. This is the question that should be ringing in your ears before you even think about making an investment. If you can get 2.125% with zero risk, why on earth would you ever take on any risk in stocks, in crypto, in a buddy's new business for a potential return that's less than that? It just makes no logical sense.
Okay, so that's the theory. But let's see how this actually works when the rubber meets the road. This brings us to Section 4, a lesson in real estate. Because, let's face it, sometimes the most important lessons are the ones that hurt a little. So, the author of our source material shares this personal story. He was tied up in a real estate deal for years, and when he finally got out, he'd pretty much just broken even. He hadn't made any money, but he hadn't lost any either. Or, so he thought. So, did he really break even? Well, when you look at it through the lens of our risk-free standard, the true return was actually a loss. Why? It's all about opportunity cost. That same pile of cash, if he had just parked it in those risk-free treasury bonds, would have earned a guaranteed return with zero stress and zero headaches. So breaking even on paper was actually a pretty big loss in reality. That story about the real estate deal just perfectly captures why this whole risk-free standard thing is so critical. So now we get to take that lesson and move on to the final and most personal piece of the puzzle. Section 5. What is your price? Now it's time to create your own rule.
And the logic here is actually pretty simple. Step 1. You take that risk-free rate, and you make it your absolute floor. Anything that can't beat that is an immediate no. Step 2. You ask yourself the really important question. How much extra return do I need to get paid to make all the stress, all the uncertainty, and the chance of losing my money worthwhile? And that extra bit? That's what we call your personal risk premium. So, to give you a real example, the author shares his personal rule. He won't even think about a risky investment unless it has the potential to pay him at least 1.75 times whatever the risk-free rate is. So if the Treasury note is paying 2%, he needs to see a path to at least 3.5% from a stock or something else. That's his price for rolling the dice. And I really want to stress this part. His number isn't your number. This is not a one-size-fits-all thing. You have to decide for yourself what your time is worth, what your capital is worth, and what your peace of mind is worth. You have to make your own rule. And once you have that rule, everything becomes clearer. You can finally tell the difference between a real investment and a simple gamble. See, an investment is a calculated decision where the potential upside actually justifies the risk you're taking, according to your rules. A gamble is just a high-risk, high-gain trap where the odds are almost certainly stacked against you. So, as we wrap things up, I want to leave you with this one last thought. When you strip away all the numbers and all the charts, this whole process comes down to a really personal question. Having a clear system isn't just about trying to make more money, it's about being able to sleep at night. So, what is that peace of mind worth to you? Hey everyone, welcome. Today, we're going to tackle a part of the financial world that a lot of people tend to overlook: bonds. We're going to break down exactly how you can figure out what they're worth and, more importantly, why they're such a critical piece of any smart investment strategy. So let's just dive right in. For a lot of folks, especially if you're new to investing, bonds can feel, well, a little complicated, or maybe just plain boring compared to the roller coaster ride of the stock market. But here's the thing, the real secret. Understanding bonds is kind of like having a superpower. They are an incredibly powerful tool for not just building your wealth, but for protecting it too.
All right, so here's how we're going to break it all down for you. We've got 5 parts. We'll start with the absolute basics, then we'll get into what actually makes bond prices move up and down. We'll touch on the math, don't worry, it's painless. Then we'll map out some really smart strategies and wrap it all up with the risks you need to know about. It's a complete roadmap to get you comfortable with bonds.
Okay, let's jump into our first section. We're going to strip away all the confusing finance speak and get right to the heart of what a bond really is.
At its core, a bond is just a loan. Seriously, that's it. When you buy a bond, you are lending your money to someone else, usually a big company or a government. Think back to those old U.S. war bonds from history class. The government needed cash to fund the war, so they sold these bonds to everyday citizens, and in exchange, they promised to pay them back down the road with interest. It's the exact same idea today.
Okay, so a bond is a loan. Simple enough. But, that's where the simple part ends and the interesting part begins. Because after that loan is made, its value can actually change. So in Section 2, we're going to look at what makes a bond's price go up or down once it's out there in the market.
There are really 3 main forces pulling the levers here, and we're going to dig into each one. We've got interest rates, which are mostly controlled by central banks like the Fed. Then there's inflation, the speed at which your money becomes less valuable. And finally, the financial health of the company or government that issued the bond in the first place.
All right, this right here is the golden rule of bonds, so you want to remember this one. It's all about this inverse relationship. Let's imagine you buy a $1,000 bond that pays you a fixed 5% interest payment every year. A year goes by, the economy cools off, and now new bonds being sold are only paying out 4%. So which bond is more valuable? Yours is, of course. People would literally pay you more than $1,000 to get their hands on your bond because that 5% payout is better than anything new they can get.
And this chart, it lays out that exact point perfectly. Just look at the row for a 5% bond. When the market interest rate is also 5%, your bond is worth exactly what you paid, $1,000. But hey, look what happens if market rates drop to 3%. All of a sudden, your bond is worth almost $1,400. And the opposite is true. If rates shoot up to 7%, the value of your bond drops. This is so important for understanding why the best time to buy bonds is often when interest rates are high.
Now for our second driver, inflation. And I absolutely love this quote. It's the perfect analogy. Just think about it. If your bond is paying you 4% interest, but inflation is also running at 4%, how much money did you really make? 0. Nothing. Your entire return was just eaten away by the rising cost of everything. Inflation is like a silent thief for these kinds of fixed income investments.
The third driver is all about risk. So let's just reframe this for a second. When you buy a bond, you're the one doing the lending. So you have to ask yourself the same question any loan officer at a bank would ask. Is this person or company actually going to be able to pay me back? The financial stability of whoever issued the bond is, well, everything.
And hey, just like you and I have a personal credit score, bonds get their own report card. These agencies, you've probably heard of them, Moody's, S&P, Fitch, they do a deep dive on the issuer's finances and slap a grade on the bond. AAA is like getting a perfect score, super safe. Anything down in the B category or lower, that's what they call junk bonds. A lower rating means a higher risk they won't pay you back, but it also means they have to offer a much higher interest rate to convince you to take that risk. Okay, on to Section 3. We're going to touch on the numbers behind all this. But hey, don't worry. You don't need to be a math genius for this part. We're not going to get lost in the weeds, but it is important to get the concepts. And a really key tool here is something called the yield curve.
A yield curve sounds complex, but it's really just a picture. It plots the interest rates of bonds with different timelines. So on the left, you see a normal curve, sloping up. That makes sense, right? You'd expect to get paid more for lending your money out for 30 years than for just 1 year. But now look at the one on the right. It's upside down, or inverted. This means short-term bonds are paying more than long-term ones. That's weird, and it's a huge red flag that often signals a recession is on the horizon. Now, this gets to the real magic of compounding interest, but it also shows why it can get so complicated. See, your bond pays you these interest payments, your coupons, usually twice a year. If you just take that cash and spend it, the math is easy. But the real power comes from reinvesting that money. As you can see on the right, taking that cash and buying more assets, well, it dramatically boosts your total return. The hard part, of course, is that you have no idea what interest rates will be in the future when you go to reinvest.
So yeah, trying to map out every single future interest payment and what you might earn on it for the next 30 years, it looks like a nightmare, right? Well, the good news is you absolutely do not have to do that.
Thank goodness for the internet, right? There are tons of free online calculators that do all of this heavy lifting for you. Whether you want to see the future value of all your reinvested interest payments, like on the left, or you just want to know what your bond is worth on the market today, like on the right, the tools are literally just a click away.
So now that we've got the fundamentals down, we get to the fun part. Let's talk strategy. This is where we go from theory to practice. How can we use bonds to actually build wealth and not just sit on the sidelines?
So here it is, the game plan, laid out nice and simple. Ideally, you want to buy long-term bonds when interest rates are high. You know, when the Fed is trying to cool down the economy. You lock in that great interest rate and just collect your payments. And then you wait. Because when the economy eventually slows down and the Fed starts cutting rates again, your bond with its high payout becomes super valuable. You can sell it for a nice profit and then take that cash and go buy stocks, which are probably on sale at that point.
Now, I know what you might be thinking when you see this. Wait a minute. Stocks have historically returned over 11%. Why would I ever bother with bonds at 5%? And look, that's a totally fair question over the very long haul. But look closer. In that decade from 2002 to 2011, a period that had two massive stock market crashes, bonds actually did better than stocks. They provide that stability and predictable income when everything else is going crazy.
Okay, for our last section, we got to cover some of the fine print. The bond world has a few tricky spots, and it's super important to know what to watch out for before you start putting your hard-earned money to work.
Okay, 3 key things to have on your radar. First up, callable bonds. This means the issuer, the company you lent money to, has the right to pay you back early. This is a risk for you because when do you think they'll do that? When interest rates have dropped, the exact moment you were hoping to sell your bond for a big profit. Second, if you're really worried about inflation, you can look into TIPS. Their value actually goes up with inflation. And finally, you have choices in how you invest. So this brings up a big question. Should you be buying individual bonds one by one, or should you buy a bond index fund? Well, buying an individual bond gives you the biggest potential profit from those interest rate swings we talked about. But they can be pricey, and you're kind of putting all your eggs in one basket. On the other hand, a bond index fund is cheap. You can buy it just like a stock, and you're instantly diversified across hundreds of different bonds. The trade-off is its price won't be as sensitive, so you lose some of that big profit potential.
And that brings us to the final, really powerful idea we want to leave you with. The point here isn't just about making a little extra interest. It's about thinking differently from the crowd. When everyone else is getting greedy and piling into a hot stock market, that's when you should be quietly building up an armory of high-quality bonds. Because when that inevitable storm hits the market, those bonds are your safe harbor, and the cash you get from them is your ammunition to go buy great assets when they're cheap.
At the end of the day, that's what this is all about. Bonds aren't just some passive, boring investment. When you understand them, they become a strategic tool you can use on both defense and offense. So the question to leave you with is this. Now that you've got the tools, what's your plan? How are you going to prepare your portfolio for whatever the market decides to throw at us next?
So how do you figure out what a stock is really worth? Separate from all the hype and the noise you see on the news every day. It can feel, well, pretty overwhelming, right? But it doesn't have to be. Today, we're going to break down a super clear, step-by-step approach to finding a company's true value. And it's inspired by some of the best investors on the planet. Okay, let's get into it.
Everything we're talking about today really starts with this idea from Warren Buffett. The core philosophy is this. Figure out a company's real, underlying value, its intrinsic value, before you ever even glance at its stock price. When you do that, you're not getting swayed by market panic or crazy trends. Nope, you're focused on the business itself. And that's exactly what we're going to learn how to do. Here's our game plan. We're going to start with 4 rules that are totally non-negotiable for any investment. Then we'll look at the human side of things, leadership, and whether the company has a future. After that, we'll see why stability is so crucial. Before, we jump into the math to calculate what a stock's really worth. And finally, we'll wrap up with the huge difference between being an investor and being a speculator.
All right, first things first. Any company we even consider has to pass 4 critical tests. I want you to think of this as your essential checklist. If a business fails even one of these, we're done. We just move on. All 4 have to be a yes, no exceptions.
So what are these 4 rules? 1. We need vigilant leaders running the show. 2. The business has to have real long-term prospects. I'm talking decades. 3. Its performance has to be stable and, just as important, understandable to us. And finally, number 4, after it's passed all that, the stock has to be selling for less than what we figure out it's truly worth.
Let's dig into those first 2 rules, which are all about the quality of the business and the people in charge. See, before we even dream of crunching numbers, we have to feel good about the management team and the durability of the company itself.
So, vigilant leadership, what does that really mean? Well, it boils down to avoiding the one thing that can kill even a great company: too much debt. And we can measure this pretty easily. We're looking for a debt-to-equity ratio below 0.5. That tells us the company isn't dangerously in debt. And we want a current ratio above 1, which means it has more than enough cash on hand to pay all its bills for the next year. Simple as that.
Okay, so you found a company with awesome, responsible leaders. Check. That's rule 1. But for rule 2, long-term prospects, there's a really practical reason we need to be in it for the long haul. And that reason, my friends, is taxes. Because as you're about to see, jumping in and out of stocks has this hidden cost that can absolutely demolish your returns over time.
And just look at this chart. Wow, it just lays it all out, plain as day. On the left, you invest 10 grand, and in 20 years, it grows to over $61,000. Nice. But on the right, same investment, same growth, but you sell and pay a 25% tax bill every single year. Your final number? Just $39,500. That is a massive $21,000 difference. All that money, poof, gone to taxes. This is the power of finding a company you can just buy and hold.
Okay, on to our 3rd rule. We've got good leaders, we're thinking long-term. What's next? Stability. And this one is huge. Why? Because if a company's results are all over the place, up one year and down the next, any attempt we make to predict its future is just a wild guess. Predictability is what makes all of this possible.
And this is just the perfect analogy. Look at Andrew on the left. Straight A's. Year in, year out, you could bet your bottom dollar he's getting an A in 12th grade, right? Now look at Mike. His grades are a total roller coaster. Who knows what he's going to get? It's impossible to predict. As investors, we want to find the Andrews of the business world, not the Mikes. All right, we have officially passed our qualitative tests. We found a stable, long-term business with great leaders. Now we are ready for rule number 4, finding out if it's undervalued. And this is where we get into the numbers. This is the math behind the magic.
Now, the most fundamental concept for all of this is something called book value. Don't let the business jargon scare you. It's actually super simple. It's just a company's net worth. Think about it like this. If you sold everything you own, paid off every single one of your debts, the money left over, that's your personal net worth, your equity. Book value is the exact same thing, just for a business. And this slide really brings it home. You've got your assets, stuff you own. You've got your liabilities, stuff you owe. The difference is your personal equity. A company's balance sheet, it might look complicated, but it's just a big list of its assets and liabilities. The concept is exactly the same. When you strip it all down, it's that simple.
And here's what that stability looks like in the real world. This chart is Johnson & Johnson's book value per share over 10 years. Look at that beautiful, steady upward climb. It's not some crazy, jagged line, it's an Andrew. This is the kind of predictable, boring in a good way, growth that we can actually work with.
So because J&J's growth has been so consistent, so predictable like Andrew's report card, we can do something really powerful. We can make a reasonable guess about its future. By just looking at its past growth year after year, we can estimate a future growth rate. For J&J, that comes out to about 12.1% a year. And this number is the engine for our entire valuation.
But hold on, where does this growth actually come from?
It's not magic. It comes from profits, what we call earnings per share. And with those profits, a company has two basic choices. One, it can reinvest the money back into the business, which makes the book value grow, or two, it can pay that money out directly to you, the shareholder, as a cash dividend. The really great companies find a way to do both.
Okay, this is it. This is the moment we've been building up to. We've got our stable company, we've got its book value, and we have its estimated growth rate. It is time to put it all together and finally calculate what one share of Johnson & Johnson is actually worth.
Okay, so we plug our numbers into a valuation formula. We've got the current book value, the dividend it pays, and that 12.1% growth rate. The last piece of the puzzle is something called a discount rate. Just think of it this way. A dollar you get 10 years from now is worth less than a dollar in your hand today, right? So we have to discount all that future cash to see what it's worth today. A good, safe baseline for this is the interest rate on a 10-year government bond. It's basically considered risk-free. When we use that rate, the formula spits out an intrinsic value of $76.20 per share. So our calculation says the stock is worth $76, but at the time, the market was selling it for only $65. So what does that tell us? It means if we buy it at the market price, our expected return should be better than that risk-free bond rate we used. But how much better?
Well, we can actually work backwards to figure that out. We use the same calculator, but this time we plug in the $65 market price. Then we just play with that discount rate, which is really our expected return, tinkering with it up and down until the calculator's value equals 65. And through a little trial and error, we find that the market is pricing J&J to give us an estimated return of about 3.59% per year.
And this brings us to the final crystal clear decision. On one hand, you can get a guaranteed 1.71% return from a government bond with basically zero risk. On the other hand, you can buy a very stable, predictable company like Johnson & Johnson and get an estimated return of 3.59%. You're taking on a little bit of risk, sure, but you're being compensated with more than double the potential return. The choice is yours.
Now, this whole process we just walked through, that is investing. It is based on predictable value. But what happens when a company isn't stable? That's when you cross a very important line, from investing into speculating. And knowing the difference? Well, it's everything.
Just take a look at this. This is our Mike from the student analogy. This is Sirius XM. The book value is all over the place, starting from basically zero, and that debt-to-equity ratio, oh my gosh, it's astronomical. How in the world could you use these chaotic numbers to predict what this company will be worth in 10 years? You can't. It's impossible. Trying to do so isn't valuation, it's just pure guesswork.
And this really brings us to our final and maybe most important distinction of all. With a company like Johnson & Johnson, the business is so stable, so predictable, it's actually hard to name one specific thing that could sink it. That's investing. But with a company like SiriusXM, the risks are staring you right in the face. The huge debt, the wild swings. You know exactly what could go wrong. And that is speculation. So the question I want to leave you with isn't which stock is going to go up. The real question is, am I an investor or am I a speculator?
All right, let's talk about one of those terms in finance that can be a little confusing: preferred stock. You hear about stocks, you hear about bonds, but this thing, it's kind of a mix of both. It's this weird, interesting hybrid. So today, we're going to break down exactly what it is, how it works, and why a company would even offer it. So here's how we're going to do it. First, we'll dive into why it's called a hybrid. Then, we'll get into something really important. What happens if a company goes belly up? Who gets paid? After that, we'll decode the fine print, all the special features. Then, we'll actually run the numbers so you can see how it affects a company's value. And finally, we'll wrap it all up to help you figure out if this kind of investment makes sense.
Okay, let's jump right into this core idea. How can one single investment act like it's part stock, but also part bond? It sounds a little strange, but it's actually the key to understanding the whole thing.
Right, so you probably have a good handle on common stock. You buy a piece of the company, you might get a vote, and you hope it grows in value. But what if you could get a stock that behaved more like a bond? One that paid you a fixed, predictable amount of money, like clockwork. Well, that's exactly the idea we're playing with here. And here's the trade-off, laid out plain and simple. With common stock, you get voting rights. You have a say. But your dividends, they can be all over the place. With preferred stock, you give up that vote. No say in how the company is run. But in exchange, you get a fixed dividend. It's a deal.
You sacrifice control for the sake of stability and a more predictable income stream. Now, that word priority is a huge deal, especially when things go south. So let's talk about the payout priority, because if a company goes bankrupt, your spot in the line to get paid can mean the difference between getting your money back or getting nothing at all.
Just picture it. A company fails. What happens next is basically a giant corporate garage sale. They sell off everything, the buildings, the computers, the patents, to turn it all into cash. Then, with that pile of cash, they start paying off their debts. And only if there's anything left over after all the lenders are paid do the investors get to divvy it up. And this right here is the pecking order. It's super strict. At the very front of the line, you have the bondholders. They're lenders, so they get their money first. Period. Once they're fully paid, then the preferred stockholders get to step up. And who is at the very, very back of the line? You guessed it, the common stockholders. They get whatever scraps are left, if any. That middle position is what defines preferred stock. The source material gives us a pretty blunt example here. Imagine a company has $100,000 in assets, but owes $200,000 to its lenders. Well, the math is simple, and it's not pretty for shareholders. The bondholders are owed $200,000, and there's only $100,000 available. So who gets it all? The bondholders, of course.
So in that scenario, what's left for the preferred shareholders and the common shareholders? Yup, a big fat zero. Nothing. This is the cold, hard reality of risk, and it's why understanding that pecking order isn't just academic, it's absolutely essential. Okay, so we get the big picture risk, but now let's zoom in a little bit. With preferred shares, the devil is always in the details. You really have to read the fine print to know what you're getting into. And that fine print has a name, the indenture. You can just think of this as the official rulebook for your investment. It's a legal document that lays out every single rule, feature, and condition. Seriously, before you'd ever consider buying one of these, you have to know what's in its indenture. It's totally non-negotiable. So inside that rulebook, you're going to find a few key things. Par value, that's just the face value of the stock. The dividend rate is your fixed payment. Callability means the company can force you to sell it back to them. Now, cumulative is a big one. That means if they miss a dividend payment, they still owe it to you. And convertible gives you the option to swap your preferred shares for common stock later on. Let's dig into that callable feature for a second, because it's super common. This gives the company, not you, the power. They have the right to buy the shares back at a predetermined price. Why does this matter? Well, it basically puts a ceiling on your potential profit. They'll often do this when interest rates fall, buying back your shares for, say, the $100 par value plus a little extra, like 1 year's dividend. All right, brace yourself. We're about to do a little math. But trust me, this is a calculation that every serious investor needs to know, because it helps you figure out what a company's common stock is really worth. The easiest way to think about a company's equity is like a pie. But before the common stockholders can get their slice, the preferred stockholders get to cut their piece out first. So to find out what's actually left for the common folks, you have to take the total pie and subtract the value of all the preferred shares. Let's see how that works. We're going to break this down into 4 really simple steps. First, we figure out the value of just one preferred share. Second, we find the total value of all the preferred shares. Third, we subtract that amount from the company's total equity. And fourth, we divide what's left by the number of common shares. Ready? Let's start with step 1. Okay, so step 1, let's find the value of one share. And to make it interesting, let's say it's a cumulative share. Remember, that means they owe you for any missed payments. So if the call price is $110, but the company is 2 years behind on its $9 dividend, we have to add those missed payments, they're called dividends in arrears, back in. That's $18 owed. So you add the $110 call price to the $18 in missed dividends, and you get a book value of $128. That's the real claim that each preferred share has on the company right now. Now for the easy part, step 2. We just take that $128 value per share and multiply it by how many preferred shares there are. In this example, there are 1,000. So the total claim of all the preferred stockholders is $128,000. On to step 3, let's say we look at the company's books and see $1 million in total stockholders' equity. Well, we now know that $128,000 of that is already spoken for by the preferred shareholders, so we subtract it. That leaves $872,000 that truly belongs to the common stockholders.
And here's the final step. We take that $872,000 in common equity and divide it by the number of common shares. In this case, 2,000. And that gives us a true book value of $436 per common share. See? Doing this math gives you a much more accurate picture of the company's real value.
So we've gone through how it works, the risks, and even the math. So what's the final verdict here? Is preferred stock something you should consider? Let's put it all into perspective.
I think this chart lays it out perfectly. On one end of the spectrum, you have bonds, lower risk but lower potential return. On the other end, common stock, much higher risk but also the highest potential for growth. And where does preferred stock fit? Right smack in the middle. It's that middle ground option, offering a balance. It's generally safer than common stock, but usually offers a better payout than a bond, which can be really appealing for investors who are focused on generating income. So there you have it. You know what this hybrid is all about. Its place in the line, the fine print you gotta watch out for, and even how to calculate its impact. So the final question really isn't for me, it's for you. Now that you understand how it works, where might a lower risk, steady income investment like this fit into your own financial plan?
Have you ever stopped to think about how some people can earn millions of dollars a year and still end up totally broke? It's kind of crazy, but it happens way more than you'd think. The truth is, a big paycheck doesn't automatically make you wealthy. So in this explainer, we're going to pull back the curtain on a powerful secret from the world of big business that can absolutely change your financial life. Let's dive in. Here's what we're going to cover. First up, we'll dig into the shocking reason why even super high earners can go broke. Then we'll get into the cash flow solution that they're all missing. After that, we're going to teach you a new way to think, to see yourself as your own personal corporation. And finally, we'll see how one simple tool can put you in complete control of your financial destiny.
So to really get a handle on this, we're going to look at a group of people you'd never ever expect to have money problems. Professional athletes. Guys making millions of dollars every single year. Their stories, believe it or not, shine a huge spotlight on a financial trap that can catch any of us.
Now get ready for this, because this number is just wild. A report from Sports Illustrated found that a staggering 78% of former NFL players are either bankrupt or in deep financial trouble just 2 years after they stop playing. I mean, that's not a typo, just 2 short years.
And it's not just a football thing. The story is pretty much the same in the NBA. An estimated 60% of players are completely broke within 5 years of hanging up their sneakers for good.
You gotta ask, right? With these massive multi-million-dollar contracts, all the endorsement deals, the fame, how on earth does this keep happening? Well, the answer is actually a lot simpler and a lot more common than you might think.
The real problem isn't about not having enough income. It's this trap we call lifestyle inflation. It's this belief that, oh, if I just get that next raise, everything will be fine. But you know the drill. You get a $5,000 raise, and what do? You go buy a new car with payments that add up to $6,000 a year. You're actually worse off than you were before.
And here it is, the single biggest mistake they made. They never did the one thing that truly builds wealth. They didn't use their huge paychecks to buy assets, things that generate even more income all by themselves. They were basically just drinking from a well that was guaranteed to run dry in a few years.
Okay, so we've seen the problem up close. Now for the good part, the solution. It really comes down to a fundamental shift in how you think, a shift that separates the people who are just rich for a little while from those who are wealthy for a lifetime.
This right here, this is the golden rule. This is the whole game. The goal isn't just to earn more money from your job. The real goal is to buy assets that create a river of cash that flows to you, month after month, year after year, whether you're working or not. Let's break this down with a super simple example. Say, in step 1, you take $500 and invest it in a stock that pays a 4% dividend. Boom! Just like that, in step 2, you've basically given yourself a $20 a year raise. As step 3 shows, that's an extra $1.60 coming in every month for doing nothing. It might not sound like a lot, but what's really happening is that your money is now working for you, and that creates this incredible compounding effect over time.
And that perfectly shows the huge difference in mindset. Remember the athletes? They were emptying a well that was only going to be full for a few years. When you focus on buying assets, you're building your own well, one that literally never runs dry. Your cash flow becomes the lifeblood of your entire financial future.
All right, let's take this up a notch with a really powerful way to think about all this. We're going to take everything we've learned and start looking at your personal finances like you're running a billion-dollar company.
That's right. Seriously, the biggest, most successful companies in the world, they manage their money using these exact same principles. And the best part is, you can use the same tool they do to get your own money straight, starting today.
And that tool is called the cash flow statement. Now, don't let the fancy name scare you off. It's really simple. It's just a report that shows where all your money came from and where it all went. That's it. It's the story of your money.
And that story is always told in 3 parts. First, you have operating activities. That's basically money coming in from your job or your business. Then there's investing activities. That's you using your cash to buy things like stocks or real estate. And finally, financing activities, which is all about your debt, either taking it on or, even better, paying it off.
So here's what that looks like for a regular person who we'll just call stock U. You can see their income from operating is a positive number, but check out investing and financing. They're negative. And in this story, that is a fantastic thing. It means this person took $16,000 to buy assets that will make them richer and another $26,000 to crush their debt. They're literally building a better future.
Now, let's look at how one of the biggest companies on the planet, Johnson & Johnson, does the exact same thing. This is their real cash flow statement. I know, it looks complicated, but I promise you, the story it's telling is exactly the same as our Stock U example. Okay, we are in the home stretch. Now, don't get lost in all the little numbers and accounting terms on their statement. We're just going to focus on the big picture, those same 3 categories we talked about, to see what these numbers tell us about this corporate giant. Just look at this. The company brought in a mind-blowing $14.3 billion from its operations. And then, what did they do with it? Just like our Stock U, they put that cash to work. They used $4.6 billion for investing and another $4.5 billion for financing, things like paying down debt and rewarding their owners.
And after all that, after investing in its future and paying its bills, what did they have left? A cool $5.2 billion in cash was added right to their bank account for the year. I mean, that is the definition of financial power.
So let's just stop for a second and bring this right back to you. Imagine if this was your personal cash flow statement. What would that mean for your life? It would mean freedom. The freedom to invest more, to wipe out your debt, or to build a massive safety net so you never have to worry about money again.
And that's really the whole point here. For a company, a healthy, positive cash flow means it can grow its value and reward its owners. And for you, it's exactly the same. It means you can grow your own personal wealth and lock in your financial independence. So we'll leave you with this one final thought. Every single dollar you make and every dollar you spend is writing a story. The only question left to ask is, what story is your cash flow statement telling about your future? You know, it's funny, we spend so much time figuring out what to buy, but there's an even harder question that every single one of us has to face. When do I sell? It's the one question that can absolutely tie you up in knots, because so often it's driven by fear or greed, not logic. But what if it didn't have to be? What if there was a clear, math-based way to get the right answer? Well, that's exactly what we're going to break down.
So, let's start with an idea that sounds, well, kind of crazy at first. Never sell? I know, you're probably thinking, wait a minute, I came here to learn when to sell. And yeah, it sounds totally backward. But stick with me, because this one little mindset shift is the key to everything. The goal isn't to get good at selling. The real goal is to get so good at buying that you find businesses you never actually want to part with. All right, so here's our roadmap. First, we're going to dive deep into that never sell mindset. Then we'll get real and talk about what to do when a great company starts to stumble. That'll lead us to a tale of 2 stocks where we'll set up a direct showdown. And then comes the main event. We are going to do the math, step by step. That leads to what I'm calling the $37,000 decision, and we'll wrap it all up with the only 2 reasons you'll ever need to sell.
Okay, first things first. The biggest mental hurdle we have to clear is this. You've got to stop thinking like you're just renting a stock for a little while. You're not a trader. You're a business owner. Every share you buy is a tiny piece of a real company that you now own.
Let me put it this way. Imagine you open a little coffee shop in your neighborhood. The first year is a blockbuster. You make a 30% return on your money. The line is out the door. People love your coffee. What's your first instinct? Is it to put a for sale sign in the window? No way, right? Of course not. You'd be thinking, how do I make this even bigger and better next year? That right there is the owner's mindset.
And when you think like that, a few amazing things happen.
You stop obsessing over the stock's price wiggling up and down every day and start focusing on the health of the actual business. That alone helps you dodge so many emotional mistakes. And here's the kicker, the tax man. As long as you don't sell, you don't pay capital gains tax. That means 100% of your money keeps working and compounding for you. It's a page right out of the playbook of guys like Warren Buffett.
So the never sell idea is the dream. It's our North Star. But we live in the real world. And in the real world, sometimes great companies stop being great. Sometimes things go wrong. And that's where the ideal meets reality. Let's go back to that coffee shop. What if a new manager takes over, starts buying cheap beans, the place gets dirty, and they run up a huge credit card bill? Your amazing business is starting to crumble from the inside out. You wouldn't just close your eyes and hope for the best, would you? As the owner, you'd have to step in and make a really tough call. And it's the exact same thing with your stocks.
So to make this super clear, let's walk through a real-world scenario. Let's say 3 years ago, you found a great company. We'll just call it company XXX. You bought 1,000 shares at $50 a pop. Back then, it was a fantastic business, but lately, you've noticed some things that are making you a little uneasy.
Now on the surface, everything looks fine. The stock price is actually up, so you've made some money. But you're a smart investor, so you've been looking under the hood. And you don't like what you see. At the very same time, you found a different company that looks really promising. And this sets up the ultimate dilemma. Do you stick with the devil you know, or do you jump ship?
And the red flags at company XX are, well, they're bright red. When you bought it, its debt was super manageable, a debt to equity of 0.5. Now some new folks are in charge, and that number has skyrocketed to 3.0. They've loaded the company up with debt. On top of that, earnings are way down, their guidance for the future is gloomy, and when you run your own numbers, you figure the company is really only worth about $50 a share. This simply is not the business you originally invested in.
So you start looking around, and you find this other business, company TTT. And this table, this really lays out the whole problem perfectly. Your current stock, XXX, is selling for $70, but you think it's only worth $50. It's overvalued. Meanwhile, this new company, TTT, is selling for $50, but you think it's worth $55, it's undervalued, and it looks like it has better growth ahead. So here's the million-dollar question. Is TTT a good enough deal to make it worth selling XXX and taking that tax hit?
Okay, this is the moment of truth. This is where we take all the emotion, all the gut feelings, all the what-ifs, and we push them to the side. We are going to make this decision with one tool and one tool only. A calculator. I'm going to walk you through it step by step to see which choice actually makes you wealthier down the road. And don't worry, it's a simple 3-step process. First, we got to figure out how much cash we'll actually have left to play with after we pay Uncle Sam. Second, we're going to do a little detective work to figure out what growth rate the market is expecting for each stock. And finally, we'll use those numbers to fast forward 10 years and see which pile of money is bigger. Ready? Let's do this. Step 1, the tax bill. This is so important, and it's what trips a lot of people up. You bought in for $50,000. Your shares are now worth $70,000. That's a $20,000 profit, which is great. But the moment you sell, you owe taxes on that gain. If we assume a 15% rate, that's a check for $3,000 you've got to write. So you don't have $70,000 to reinvest. You have $67,000. That's our new starting number.
Step 2. Now, this part seems a little technical, but it's actually pretty cool. We're going to work backwards. We know company XXX is trading at $70. So we ask a calculator, hey, what growth rate does the world need to believe in for this company to be worth $70 today? And the answer for XXX is a tiny 1% per year. The market has basically lost faith. We do the same thing for company TTT, and the market is pricing in a much healthier 5.5% growth. See the difference? This tells us what the market thinks is going to happen. And now for the final step, the crystal ball. We have everything we need. We've got our starting capital for both options, and we've got the growth rates the market is giving us. So let's just plug these numbers into a simple future value formula and see what happens over the next 10 years. So let's look at option 1 first. We just stand pat and hold on to company XXX. We start with our full $70,000. We let it grow at that sleepy 1% rate for 10 years, and at the end of the decade, our investment is worth about $77,320. Okay, not terrible, but not exactly setting the world on fire either.
But now, check out option 2. Here, we take the hit, we sell, we pay our taxes, and we start with a smaller pot of money,
$67,000. But we invest that money at the much stronger 5.5% growth rate. And over 10 years, that smaller pot of money blossoms into more than $114,000. Now that's a different story.
So, we've done the work, we've run the numbers. It's time to put them side by side and see what the real, tangible impact of making this one logical choice actually is. This isn't just about feeling better, it's about being better off, financially.
$37,000 and some change. That's how much more money you'd have in 10 years by making the switch. That's the price of inaction. It's the cost of holding on to a deteriorating business out of loyalty or fear of paying taxes. And that number? That didn't come from a gut feeling, it came from a calculator. That's the power of letting the math guide your hand.
So, after all of that, what's the big lesson? How do we take this whole scenario and boil it down into something you can actually use? Well, it all comes down to two simple, powerful rules. This is your new framework for making the call.
Okay, here they are, your 2 and only 2 golden rules for selling. Rule number 1, the business has fundamentally changed for the worse. The story's broken. New management, too much debt, failing profits, whatever it is, it's not the company you bought. That was our company XX. Rule number 2, you have found another better opportunity, and you can prove with math that it will give you a better return even after you pay the taxes to make the switch. That's it.
And that is the absolute key to all of this. Selling because a stock's price went down is panic. Selling because you read a scary headline is fear. That's all just guesswork. But making a strategic decision to sell based on a broken business or a mathematically superior alternative, that's not guessing, that's a plan.
So I'll just leave you with this one last question to chew on. Take a hard look at your own decisions. When you've hit that sell button in the past, what was really driving you? Was it a clear, logical process like the one we just went through? Or was it something else? A gut feeling? Fear? Because as we just saw, the difference between those two approaches isn't just academic. It can literally be worth thousands and thousands of dollars.
All right, let's dive into one of the most powerful and honestly often overlooked metrics in the entire world of investing: return on equity. You know, if you really want to invest like the best, you've got to understand what they're looking at. And for Warren Buffett, return on equity, or ROE, is a big one. He gets a very simple truth. If a company can consistently churn out a high return on its equity, well, the stock price is probably going to follow. You just can't ignore an endorsement like that. So, to really get why this one number is such a powerhouse, we're going to forget about complex corporate balance sheets for a minute. Instead, let's break this whole thing down with a simple story. Let's meet Jill. So this is Jill. She's a successful doctor, makes a great salary, and, you know, like most of us, she's got expenses, she's got some loans, but she's a really good saver. She manages to put away a nice chunk of cash every single year. So one day, Jill sits down to figure out her actual net worth. She lists everything she owns, those are her assets, and then she subtracts everything she owes, you know, her debts. And that number that's left over, that's her personal equity. And for Jill, it comes out to a nice round $100,000. Okay, so now let's look at her income. Her take-home pay for the year is $120,000. After she pays for everything, all our expenses, which total $100,000, she's left with a net income of $20,000. This is the money she adds to her savings. And this is where we do the exact same calculation that a giant corporation would do to find its return on equity. We just take her annual net income, that $20,000 she saved, and we divide it by her total equity, which was $100,000. And what do we get? A personal return on equity of 20%. Now, let me tell you, if Jill were a company on the stock market, a 20% ROE would be absolutely fantastic. It means she is incredibly efficient at generating new wealth from the capital she already has. And just to put that 20% in perspective for you, a lot of really smart investors look for companies that can consistently post an ROE of over 7%. So Jill at 20% is just knocking it out of the park. But here's the question. Can she keep that up? Okay, now let's hit the fast forward button and see how this whole thing plays out over time. We're going to jump ahead 45 years into Jill's future because this is where the really critical lesson about ROE starts to show itself. So 45 years later, Jill has hit her big goal. Her equity is now $1 million. I mean, on the surface, that sounds like a huge success, right? But if you dig into the numbers just a little bit,
you start to see a really big problem. Sure, her equity grew, no doubt about it. But take a look at her net income. It is exactly the same. For 45 years, all she did was take that extra $20,000 and stick it in a savings account that earned basically nothing. She made her assets bigger, but she never actually put those assets to work to generate new income. So let's run the numbers again, using her new situation. We take that same $20,000 in net income, but this time we divide it by her much, much larger equity base of $1 million. The result is, well, it's pretty startling. Her return on equity has absolutely plummeted from that really impressive 20% all the way down to a measly 2%. See, she has way more capital now, but her ability to generate a return on that capital has totally collapsed. She's become inefficient. So what in the world does Jill's story have to do with looking at a multi-billion-dollar company? Well, it turns out it has almost everything to do with it. Jill's struggle is the classic story of a company that's maturing. You know, as her pile of capital got bigger and bigger, it became harder and harder to generate that same high rate of return. This is the exact challenge that businesses face when they try to scale up. Think about it. Jill failing to buy new assets that could produce more income? That's the business equivalent of a company that has one hit product and just can't innovate beyond it. Her strategy of just piling up cash is like a business taking on a mountain of debt for some huge expansion that ends up barely making a profit. It's the same exact problem. You see this pattern play out all the time as companies get bigger. They might start out as what we call a small cap, worth less than $2 billion, and they're trying to grow into a mid cap or maybe even a large cap, which are worth over $10 billion. A small cap company might have a fantastic ROE today, just like our friend Jill did at the beginning. But the huge risk for you as an investor is that this company becomes a Jill, that it won't be able to keep up that high rate of return as it gets bigger and faces a whole new set of challenges. Okay, so how do you take Jill's story and actually apply it to your own investing? Let's talk about the practical side of this and build up your toolkit for using ROE in the real world. So here's the official formula. But you can see now it's exactly what we did for Jill. We're just using the corporate lingo. Return on equity is simply the company's net income divided by its shareholders' equity. That's it. And finding these two numbers is actually really easy. A company's net income is always on its income statement, and shareholders' equity is right there on the balance sheet. Every public company has to release these reports, so the data is out there for you to find. And this all leads us to the single biggest takeaway. Finding a company with a high ROE today is good. That's great. But the real treasure, the thing you're really looking for as an investor, is a company with a proven track record of maintaining a high ROE year after year after year. That's the sign of a special business that has managed to avoid Jill's fate. And that really brings us to the final, powerful question you should be asking yourself every time you look at a potential stock. By framing it this way, you're not just looking at a number on a spreadsheet anymore. You're analyzing the company's entire story, where it's been, where it is now, and most importantly, where it might be going. Is it going to keep that magic going, or will its own success become its biggest burden?
You've seen it every single time you look up a stock quote, right? That little number labeled volume. Most of us just glance right past it. But what if I told you that number is telling a fascinating story? Well, today we're going to pull back the curtain, because what volume really tells you about a stock's price might just change how you see the market.
So here's the game plan. We're going to start by busting a huge myth about who actually sets stock prices. Then, we'll get right into the heart of what trading volume really is. After that, we'll explore the crucial difference between price and value, tell a simple story to make it all click, and I promise, by the end of this, you'll know exactly how to read the signals that volume is sending you.
All right, let's dive right in with our first section.
Okay, let's start with this big question. When you see a stock price, let's say for a giant company like General Electric, have you ever stopped to wonder who picked that number? I mean, really, who decides it? Is there some secret committee in a boardroom somewhere? Do all the millions of owners get to vote? The answer? Well, it's definitely not what you think.
You know, your gut instinct might be, well, it's got to be what all the owners think it's worth, right? Kind of like an average. But the reality is actually pretty wild. The price you see flashing on your screen is set by a tiny, and I mean tiny, fraction of all the people who own the company. We're talking less than 1% most of the time.
So, if 99% of the owners aren't setting the price, then who is? And that very question leads us right to the star of our show today, trading volume.
Okay, let's get a visual on this. Imagine this big circle here represents every single share of a company that exists. It's this massive universe of ownership, you know? It's held by all sorts of people and groups, regular folks like you and me, huge mutual funds, pension funds, the whole shebang.
Now, out of all those millions and millions of shares, the small little slice that actually gets bought and sold, the ones that change hands from a seller to a buyer on any given day, that is what we call volume.
And this slide right here shows it perfectly. Just look at how small that group of daily traders is. See that little sliver on the edge of the circle? That's the volume. Those are the people setting the price for everyone. The rest of the owners? They're just sitting on the sidelines, not part of the action on that particular day at all.
Let's put some real numbers to this to see how crazy it is. So, going back to GE, on one particular day, about 44 million shares were traded. Sounds like a lot, right? But hold on. GE has over 10 times billion shares out there in total. So if you do the math, the price for the entire company was being set by just 0.4% of its owners. Mind-boggling. And this brings us to probably the most critical idea any investor needs to get their head around. Because this tiny group of traders is setting the daily price, it creates what I like to call a tale of two prices. So here it is, the key takeaway. You've got the daily market price, which is dictated by that small active group of traders. But then you have the underlying value, and that's what the silent majority, that other 99% of owners, might believe the company is actually worth in the long run. And trust me, those two numbers can be worlds apart.
This is exactly why you've got to take that daily market price with a huge grain of salt. I mean, this quote puts it perfectly. Isn't it kind of funny, when you think about it, that the actions of just a handful of people can set the supposed value for an entire business?
To really make this idea stick, let's do something fun. Let's step away from the chaos of Wall Street for a minute and head to a small town, because we're about to see this exact same thing play out in a much simpler way. So picture this. There's a small, really successful local business. It's the pride of the town, and it's owned by 1,000 different townspeople. And to keep things simple, let's say each person owns exactly one share. Okay, now here's where it gets really interesting. Pretty much all of those 1,000 owners believe their share is worth a solid $35. But then, one day, 4 of the owners need some quick cash, and they sell their shares to 4 new people. But here's the catch. That little transaction happens for just $20 a share. And just like that, bam! The new market price for the entire business is now $20, and the rest of the town is completely stunned. So, as the weeks go by, that low $20 price starts to make some of the other owners nervous. They start thinking, uh-oh, maybe I should sell and get my money out now. So a few more people sell, and that pushes the price down even further to $15. And now, with the price so low, things get heated. The number of people trading their shares every day, the volume absolutely explodes. All of a sudden, the price of the town business is the only thing anyone is talking about. And this is the perfect parallel for the stock market. When you see trading volume go through the roof, it's a giant signal that there's a huge public argument happening over what that company is truly worth. And this big argument basically splits the town right down the middle. You've got one camp, the bears. These are the sellers who are panicking, thinking the price is just going to keep falling and they need to get out now. But then you have the other camp, the bulls. They're the buyers looking at a $35 business on sale for $15, and they think it's the bargain of a lifetime.
So now that we've seen how that plays out, what does it all mean for you, the investor? How can you actually use volume to figure out what the heck the market is doing?
If you only remember one thing from this whole explainer, make it this. High volume is a signal. Think of it like a giant flashing neon sign telling you that the active traders are in the middle of a massive disagreement about the gap between the current price and the company's real underlying value. And it's that exact battle, that intense fight between the bulls and the bears, that creates major turning points in the market. You can look back through history. Big spikes in trading volume often happen right when a stock's price is getting close to a major peak or a major bottom. It's literally the market screaming that a big change is coming. So the next time you're looking at a stock chart and you see that volume number spike, don't just gloss over it. Stop for a second and ask yourself, what's the big argument that's happening right now? And maybe more importantly, which side of that argument do you want to be on? Are you looking at a moment of fear
or a moment of pure opportunity? The answer could make all the difference.
Okay, so let's talk about investing. It's a huge topic, and one of the biggest questions people have is this. Do you hand your money over to a so-called expert who runs a mutual fund? Or is there a simpler and maybe even better way to do it? We're going to get right into it and uncover the surprising truth behind two of the most common ways to invest your money. I mean, let's just be real for a second. Trying to pick individual stocks that are going to be winners, it's really, really hard. You're supposed to be strategic, patient, and totally emotionless while your money is on the line. For most of us, it's just confusing. It takes way too much time, and honestly, it can feel like a total guessing game.
And because it's so hard, this is what most people do, right? You think, you know what? I don't have time to analyze companies all day, so I'll just pay a professional to do it for me. It sounds like the smartest, most logical thing to do. But is it really?
Here's how we're going to break this all down. We'll start with that search for an expert. Then we'll get into the big problems with mutual funds, especially the insane cost of fees. After that, I'll show you a much simpler approach with something called index funds. And then we'll put them side by side for the final verdict. All right, first up, the search for an expert. So when you decide you need help with your investments, this is almost always where you land first, in the world of mutual funds. And on paper, it sounds fantastic. A mutual fund is basically just a giant pot of money from thousands of investors, and a professional manager takes that money and invests it in a whole bunch of different companies. You get diversification instantly, and you've got an expert calling the shots. It seems like the perfect, hands-off way to invest. But here's where the story takes a sharp turn. This solution that sounds so perfect, well, it has a huge flaw. It turns out these experts fail way more often than you'd think. Get ready for this number, because it's a shocker. According to research from Morningstar, a whopping 70% of actively managed mutual funds fail to even match the average market return. Just let that sink in for a moment. You're paying extra for expert advice that 7 times out of 10 can't even keep up with the market itself. A lot of this comes down to what's called the efficient market hypothesis. Basically, the idea that all public information is already reflected in a stock's price, making it almost impossible for any one person to consistently beat everybody else. So, what's going on here? Why are they failing so often? Well, it really comes down to 3 big problems. First, we, the investors, give them our money and take it away at the absolute worst times. Second, the fees they charge are just brutal over the long term. And third, they're constantly buying and selling stocks, which actually hurts performance. Let's dig into each one. Okay, this first problem is all about human nature. Picture yourself as a fund manager. The market just crashed. For you, this is amazing. Everything's on sale. It's the perfect time to buy. But what are your investors doing? They're freaking out, calling you and demanding their money back. So instead of using your cash to scoop up incredible deals, you're forced to sell stocks at low prices just to pay back the people who are panicking. It's a system that's designed to fail. And you know who understood this fatal flaw perfectly? Warren Buffett. This is the exact reason he never, ever ran a typical mutual fund. Instead, he set up Berkshire Hathaway as a public company. That way, if investors got scared and sold their shares, he wasn't forced to do anything. He had a stable pot of money and could actually use market panic to his advantage. He wasn't handicapped by other people's fear. And that brings us to the second and, I'd argue, the biggest problem with mutual funds. Honestly, for a lot of people, this is the part that will really open your eyes. We have to talk about fees, because they're way more destructive than they look. The source material puts it this way, and it's so vivid I have to use it. Fund managers can literally suck the blood out of your investments with fees. It sounds dramatic, but it's true. Most of these funds charge you anywhere from 1 to maybe 2.5% every single year, no matter what. It doesn't sound like a big deal, but its effect is like a slow poison. Let's just take a pretty standard fee, 1.5%. By itself, it seems tiny, right? Almost insignificant. What possible difference could a little 1.5% make over time? Well, it turns out a massive one. Okay, look at this. This is where that tiny fee becomes a monster. Let's say you invest $10,000 every year for 30 years. If there were no fees, you'd have $300,000. Simple enough. But with that small 1.5% fee chipping away every year, you end up with just under $240,000. That fee didn't just take money out. It stopped a huge chunk of your money from ever growing. So what's the grand total? over $60,000. Gone. That's not a small number. That is a new car, a down payment on a house, a huge chunk of college tuition, just vanished. And what did you pay for? For the privilege of an expert who probably didn't even beat the market anyway. It's just staggering when you see the actual math. And the last big problem is something called asset churn. Look, fund managers know you're paying them that fee, so they feel like they have to look busy to earn it. This means they're constantly buying and selling stocks to prove they're actively managing your portfolio. But all this trading generates commissions, and even worse, triggers capital gains taxes you have to pay, which eats away even more of your returns. It completely defeats the whole purpose of letting your winning investments compound quietly over decades.
So, if the expert path is filled with all these traps, is there another option? Absolutely. And that brings us to the hero of this story, the boring, simple, and incredibly powerful index fund.
So, first off, what the heck is an index? It's just a list, that's it. For example, the S&P 500 is an index or a list of 500 of the biggest companies in the US. An index fund, then, has only one job, to buy all 500 of those companies and just hold on. It's not trying to be clever or outsmart anyone. It just wants to copy the market's performance, plain and simple. And this is where it all clicks into place. Index funds solve every single problem we just talked about. The fees? They're ridiculously low, often under 0.5%, because there's no high-paid manager making guesses. There's no active management, so there's no constant churn creating taxes and fees. The fund just automatically follows the index. And the best part? The index takes care of itself. When a company starts doing poorly, it gets kicked out of the index and replaced by a new, successful one. The whole thing runs on autopilot.
Okay, so we've laid out the case for both sides. Now it's time to put them head to head and get to the final verdict. I mean, this chart really says it all, doesn't it? On one side, you have mutual funds, high fees, an active manager who's trying and usually failing to beat the market, and tons of costly buying and selling. And on the other side, you have index funds, rock-bottom fees, a simple passive approach that guarantees you'll match the market, and very little turnover. When you see it laid out this clearly, the choice becomes pretty obvious.
So what does this all mean for you? It means you now have the knowledge to choose a completely different and likely more successful path for growing your money. The bottom line of this whole thing is this. For most regular people trying to invest for the future, the evidence is overwhelming. An index fund, with its tiny fees and its simple strategy of just matching the market, is very often a smarter, safer, and more profitable choice than a high-cost mutual fund. And that's really the question I want to leave you with. Now you know the hidden costs. You've seen the numbers and the evidence behind why most experts fail. So, who do you trust more with your hard-earned money? The expensive manager making a promise they probably can't keep? Or the simple, low-cost fund that just promises to give you your fair share of the market's growth? The choice is yours.
All right, let's dive into the ideas of one of the most important and maybe one of the most misunderstood figures in all of economic history. And you know what? It all kicks off not in some stuffy lecture hall, but right at a family dinner table.
So this was the question from an 11-year-old niece. And let's be real, it's a question a lot of us have probably had. Her confusion about capitalism, socialism, and communism, I think we can all relate to that. It's such a simple question, but man, it opens up a huge conversation about how our entire world is put together.
Okay, so let's stick with this scene for a second. Because when you think about capitalism, what's the very first name that pops into your head? For most people, it's the exact same name that came up in that social studies class.
And yep, you guessed it, the niece in our story, she knew the name. She connected him to the wealth of nations and said he was the guy who explained how the price of a thingy changes. And honestly, for a lot of us, that's kind of where our understanding of Adam Smith just stops. But what if that's barely scratching the surface?
But what if that connection, the one we all make between Adam Smith and, the nuts and bolts of money, is actually a huge misunderstanding? What if the father of capitalism wasn't really an economist at all? To get to the bottom of that, we have to ask, who was this guy, really, and what did he actually believe in?
We don't even know his exact birthday, but his impact? Oh, it's absolutely undeniable. The sources we're digging into today argue he's a figure who didn't just write about the world, he fundamentally changed its direction. And the key to understanding how he did that, well, it lies in a pretty surprising twist.
And boom,
Here it is, our first major curveball. That title, we all know him by, the father of capitalism. It's a crown he never would have put on his own head. In fact, he probably would have hated it. And to get why, we have to look at what he did for a living before he ever wrote a single word about economics.
Okay, so this is where we really get to the heart of it. And this isn't just some random trivia about his life. It's the absolute foundation of everything he believed. And it paints a completely different picture of the man we thought we knew.
This slide just nails the whole misunderstanding perfectly. On one side, you've got how we see him, the father of capitalism. But the reality? That wasn't even his day job. He was a professor of moral philosophy. His main focus wasn't on money. It was on what makes us good people.
In fact, his first big book had absolutely nothing to do with supply and demand. It was called The Theory of Moral Sentiments. And get this, in his own opinion, this book, not The Wealth of Nations, was his masterpiece, his greatest and most important work. So what was it all about?
So here's his big idea, and it's fascinating. He basically argued that our morality isn't just handed down to us from somewhere. No, it's born from this dance between our heads and our hearts. It comes from our ability to watch other people, to feel empathy for them, and in that process to actually understand ourselves. It's a deeply, deeply human idea.
So you gotta be wondering, right? If Smith's real passion was understanding human morality, how on earth did he end up writing the single most foundational text of modern economics? What is the connection here?
This was his big, world-changing insight. I mean, think about your favorite coffee shop. The owner isn't there because they have a deep passion for waking up at 4 a.m., right? They're there to make a living. But their self-interest, their desire to earn money, results in you getting an awesome cup of coffee. Smith saw that this exact dynamic, when you multiply it across an entire society, could create this beautiful fire of progress, giving everybody more luxuries and better services. But, and this is so important, when Adam Smith talked about wealth, he wasn't talking about a country's pile of gold or its GDP. No, for Smith, a truly wealthy nation was one where its citizens felt a wealth of contentment. That is a radical idea, even for today.
So as he looked back through history, he saw that these contented societies, they all kind of had the same recipe for success. They were places that protected individual freedoms, had a limited government, fair and fast justice, and, yes, open markets. But notice that markets are just one ingredient in the recipe, not the whole meal.
You see, that famous book of his wasn't the final picture. It was just one single piece of a much larger puzzle. It was this massive, decade-long study of just one of those components of a healthy, moral, and contented society. His goal was never just about making a nation rich. It was about building a better, more humane world.
So, why does any of this matter to us, today, in the 21st century? Well, reframing Adam Smith like this isn't just a cool history lesson. It actually has a huge impact on how we think about our own lives, especially our financial lives.
And this source material really brings this home for us. It gets that we all have material dreams. You know, maybe it's a huge house, or for the author, it was this beautiful sailboat, and there's nothing wrong with that self-interest. But then it asks us a really tough question. What comes next?
And this is really where it all comes together. We're all standing at a crossroads, right? Down one path is just pure self-interest, but on the other is the well-being of the people around us, our community. Adam Smith's entire life's work was about how to navigate that exact choice. He's challenging us to remember that even when we're chasing our own dreams, we're still part of something bigger.
And so we land on this final, really thought-provoking question. This question gets right to the very heart of Adam Smith's entire life's work. It suggests that true wealth for a country and for you as an individual isn't just about what you manage to accumulate for yourself. It's about how your actions impact the well-being of everyone else. So the next time you hear the name Adam Smith, don't just think about money. Think about morality. And then ask yourself, what kind of wealth are you really building?